Hey everyone, I am absolutely thrilled to have you here for today's explainer. We're breaking down the global finance brief for July 28th, 2026, and let me tell you, the markets are flashing some seriously mixed signals across the board today. We've got a ton of ground to cover, from major central bank moves and critical inflation data to shifting commodity prices and even some fresh warnings on artificial intelligence from the IMF. My goal today is to decode these massive macro stories for you, cut right through the noise, and get you totally dialed into the forces driving the global economy right now.
Okay, let's dive into this. Here's our roadmap for today. We're going to start with inflation and the Fed, jump into global markets and rates, check on physical assets like oil and gold, pivot over to crypto and AI, and finally wrap up with tomorrow's market outlook. We know your time is valuable, so we're going to move fast.
Starting things off with our first major section, inflation and the Fed. So the literal trillion-dollar question today is this: is the Fed going to surprise the market? Right now, practically every trader, economist, and algorithm out there has their eyes totally glued to the Federal Reserve and this looming U.S. inflation data. Major institutions are warning about massive uncertainty ahead of that 14 Fed decision. The general consensus has been that they won't rush into rate hikes, but with July inflation data still hanging in the balance, well, nobody is completely ruling out a surprise. The anticipation is palpable, mostly because the data they're working with is just so messy.
Honestly, the U.S. economy is kind of having an identity crisis right now. Just look at these conflicting data points. On one hand, the Dallas Fed reported that Texas manufacturing actually gained strength in July. Awesome, right? But then on the other hand, U.S. durable goods orders completely missed expectations. And if you zoom out to look at the whole picture, the services sector is still showing a really solid recovery, which is propping up overall economic growth. It's a classic economic tug of war. You've got growth in services and regional manufacturing suggesting the economy is running hot, but then falling durable goods suggesting a rapid cooldown. This mixed bag is exactly why predicting the Fed's next move is literally keeping institutional investors awake at night.
Let's move along and see how this builds into Section 2, global markets and rates. Because while the Fed is dealing with its own economic puzzle, central banks globally are fighting completely different inflation battles. We're seeing a massive divergence here between two of the world's biggest central banks. The European Central Bank, they're saying a rate hike is entirely inevitable because their inflation is proving to be incredibly stubborn. But jump across the channel to the Bank of England, and it is a totally different story. The BOE is preparing to just hold rates steady, pausing their hikes while they keep a super close eye on energy prices, specifically oil, and their own domestic inflation trends. It is so fascinating to see two heavily interconnected economies taking such opposite approaches to monetary policy this week. And this brilliantly illustrates exactly how fractured the global macro environment is right now. It's a real mixed bag. Over in Germany, the IFO Business Confidence Index actually beat expectations in July, showing some surprising resilience. For the broader Eurozone, the PMI index is showing a recovery, though institutions like ING are definitely warning that risks remain heavily elevated. Then, if you look at emerging markets like Turkey, signals from major global banks suggest the Turkish central bank might have to delay their expected rate cuts, totally due to these broader global pressures. But hey, despite all these shifting global crosswinds, local equity markets are still finding room to run. Case in point, the Borsa Istanbul's BIST 100 index opened in positive territory, hovering right around 13,848 points. It's just a great reminder that even when the macro data is incredibly complicated, localized momentum in corporate earnings can still drive those indices higher. All right, let's pivot now from paper markets and interest rates over to physical assets in segment 3, oil, gold, and commodities. Make no mistake, these central bank policies we were just talking about, they directly dictate the pricing of these vital resources. Gold, for instance, is currently caught in a massive tug of war. We have immense upward pressure coming from the geopolitical side. Specifically, hopes for a U.S.-Iran ceasefire in the Middle East have sparked these moments of recovery for the precious metal as risk appetites shift. But pushing down just as hard on the other side is the macroeconomic reality of a relentlessly strong U.S. dollar. A strong dollar makes gold more expensive for buyers holding other currencies, which naturally pushes the price right back down. And the result of that volatile push and pull? Spot gold is currently sitting right around $4,027 an ounce. It is a highly reactive asset right now, caught squarely in the crossfire of geopolitics and Fed monetary policy. Now, while gold is reacting to the dollar, oil is facing physical, real-world constraints. The International Monetary Fund just released a pretty vital assessment stating the oil market absorbed the war shock, but buffers are running low.
What you absolutely need to take away from this is that while demand reductions and inventory drawdowns prevented a massive price spike initially, that safety net is gone. If buffers went too low, any new supply shock could send oil prices, which are sitting around $81 a barrel, absolutely skyrocketing again. And you know what that means. It would instantly reignite the global inflation fires that central banks are trying so hard to put out.
Okay, let's shift gears with some high energy into our fourth segment, crypto and artificial intelligence. We're moving from traditional commodities to alternative and future-facing assets. Starting with the absolute bellwether of the crypto sector, Bitcoin is currently trading around $63,408. We've actually seen a slight dip of roughly 2 to 3% recently as overall market risk appetite kind of fluctuates ahead of the Fed's decision. This is pretty standard stuff. When traditional markets get uncertain, we very often see a bit of risk taken off the table in the crypto space as well. But honestly, beyond crypto, the most fascinating tech story driving financial markets today comes straight from the IMF. So the crucial point here is this dual warning they've just issued regarding artificial intelligence. They are cautioning that the rapid expansion of AI poses two severe systemic risks. First, the sheer electricity demand threatens massive power grid consumption. And second, AI tools are actively enabling attackers, escalating the risk of severe financial cyber attacks. Which brings us to what I like to call the AI paradox. On one hand, the IMF notes that AI is absolutely vital for capturing a massive growth dividend and boosting productivity, especially in regions like Europe and Latin America. I mean, it is the economic engine of the future. But on the other hand, this incredibly power-hungry tech requires immediate policy intervention to expand electricity supplies and keep prices from surging. On top of that, it desperately needs international global coordination to safeguard our financial markets from these AI-fueled cyber threats. It's the ultimate double-edged sword, right? Incredible economic potential paired with totally unprecedented infrastructural and security demands. Let's bring all these incredible threads together in our final segment, Tomorrow's Market Outlook. Here is the actionable intelligence you need to navigate the days ahead and exactly how this week is going to play out. First, today at 14 o'clock, we have the Federal Reserve interest rate decision. This is the first domino. Shortly after that, we get the key U.S. July inflation data release. This is going to tell us if the Fed made the right call or if they're falling behind the curve. Finally, as we move toward the end of the week, the momentum from the U.S. will collide head-on with the Bank of Japan's rate decision and massive big tech corporate earnings. Every single asset class we talked about today, from gold and oil to Bitcoin and equities, will be taking their cues from this exact timeline. Which leaves us with this final critical thought to end on. How are you positioning your portfolio for this upcoming volatility? Because with the Fed, global inflation, and massive technological shifts all colliding this week, honestly, standing still might be the biggest risk of all. I highly recommend diving deeper into these data points to make sure your strategy actually aligns with these rapidly changing global forces. Thank you so much for hanging out with me for today's explainer. Keep learning, stay focused, and I will see you next time as we continue to decode the world of finance.